Picture this. It's Monday morning. The new cloud platform just went live, and everyone expects instant clarity. Prime costs on a dashboard, inventory syncing automatically, and multi-location reports that finally make sense. But by Friday, the controller is back to the same old scramble. Suspense accounts, weird sales totals, inventory that doesn't tie out, and a month-end close that's somehow even slower. Welcome to the high-stakes world of digital transformation in hospitality. You're about to discover why 70% of restaurant technology implementations are bleeding money instead of saving it. Restaurant365 promises real-time visibility into your prime costs, seamless integration, and the ability to finally scale without spreadsheet chaos. But here's the brutal truth that keeps controllers awake at night. Most implementations fail before they even start. Not because the software is broken, but because of a dangerous myth called the plug-and-play fallacy. Operators believe this complex ERP will magically fix years of messy data with zero effort. Spoiler alert, it won't. And as we race toward 2026, the gap between restaurants that get this right and those that don't is becoming an unbridgeable chasm. So here's the real question driving everything. If a restaurant group invests in a modern cloud ERP, why do so many teams still fail to get the ROI they were promised? The answer isn't in the software. It's in the foundation. Because the platform isn't a magic wand. The hidden variable is the foundation you feed it. Your accounts, categories, units, vendors, and the daily discipline of how data gets entered and locked. Current analysis shows that restaurants lose an average of 30 hours every single month just manually cleaning up data messes. That's an entire employee's salary vanishing into busy work. When that foundation is messy, the platform can't create truth. It only accelerates confusion, faster imports, faster errors, and faster mistrust. But here's what really changes the game. As we hit 2026, artificial intelligence and machine learning aren't coming, they're already here. And these predictive tools, they don't work on garbage. They demand pristine, structured, trustworthy data. The same data you use to close the books is the data your forecasting and automation tools will use to schedule labor, order inventory, and predict demand. Your ability to implement AI-driven scheduling, automated purchasing, or demand forecasting doesn't depend on buying the latest shiny tool. It depends entirely on whether your data foundation is clean or corrupted. Your profitability today and your survival tomorrow hinge on getting this right. When you look across struggling rollouts, the failures aren't mysterious. They're repeatable patterns. Now let's expose the gap that kills most implementations. The plug-and-play mindset is seductive. It tells you that your new enterprise system will magically fix 15 years of messy data with a simple data dump. But that's like pouring dirty oil into a brand new Ferrari engine and wondering why it seizes up. Here's what actually happens. Legacy charts of accounts, corrupted by years of ad hoc adjustments and redundant accounts, get migrated verbatim. A legacy chart of accounts gets migrated without cleansing. POS revenue streams don't map cleanly, so new items and delivery channels fall into unclassified. Incompatible POS systems dump unmapped sales into mysterious black holes. Vendor lists balloon into thousands of duplicates because someone typed US foods 3 different ways. Generic ERP architectures, designed for widget factories, crash against the unique complexity of restaurants, ingredient-level tracking, perishable inventory, split-shift labor, and multi-concept reporting. Managers edit prior periods, so history keeps changing. Recipes aren't standardized, so actual versus theoretical reports can't expose waste. Units of measure don't convert, so teams create duplicate items. Vendor records multiply, and accounts payable becomes a minefield. And woven through all of it is the human element. Training that happens once, SOPs that live in someone's head, and accountability that shows up only at month end. The result? What promised to be a 30-day implementation becomes a 6-month nightmare of customization delays, user rebellion, and data reconciliation hell. You're not upgrading your system, you're amplifying your problems. The approach that works looks less like installing software and more like designing infrastructure. This is where everything changed. Instead of treating setup as an IT checkbox, we approached it as a capital investment in data infrastructure. The breakthrough was the controller's blueprint, a hierarchical chart of accounts that acts as your financial nervous system. First, rebuild the chart of accounts as a restaurant-specific blueprint, hierarchical for consolidation, standardized across locations, and granular where decisions actually happen. Imagine parent accounts that automatically roll up from individual stores to regional hubs to enterprise-level consolidation, all while maintaining surgical granularity. Food COGS isn't one account anymore. It's a fingerprint. Distinct accounts for proteins, produce, draft beer, bottled beer, wine, liquor. Labor isn't dumped into one bucket. It's segmented by role. Salaried management, hourly front of house, hourly back of house. Why? Because you can't fix what you can't see. Next, treat revenue like an engineered pipeline. We implemented rules-based POS mapping that acts like a traffic controller. Every new menu item, every third-party delivery fee, every promotional discount, every item, tender, discount, and tax gets automatically routed to the correct account from day one. No more mystery suspense accounts. Then align time itself. We aligned everything to a restaurant-friendly fiscal calendar, a 13-period 4-4-5 cycle, creating periods of equal length with identical weekend counts, so you're actually comparing apples to apples, and enforce a hard close so history doesn't mutate after the fact. In parallel, connect recipes to inventory with unified units of measure. We stopped the insanity of staff creating 3 different inventory entries for the same ingredient. No more beef case, beef elbas, and beef ahs floating around. One ingredient, multiple units, seamless conversion. Clean the vendor master so accounts payable stays accurate and negotiable. Vendor consolidation revealed we'd been paying the same supplier under 5 different names, unlocking volume discounts we didn't even know we qualified for. And instead of a risky big bang rollout, you phase it. Cleanse, pilot, refine, then scale. This isn't configuration, it's architecture. Once the data backbone is clean, the system stops arguing with itself. The results were nothing short of transformational. Revenue stops piling up in suspense because new items are routed correctly from the first transaction. Prime cost reporting becomes stable because COGS and labor are categorized with decision-grade detail. When we implemented the blueprint, the variance between actual and theoretical food costs dropped from 15% to under 2%. That's profit leakage we could finally see and plug. And period-over-period comparisons start making sense because the calendar is consistent and periods are locked. The biggest breakthrough is what happens in FT, actual versus theoretical. When recipes are standardized, inventory counts are disciplined, and units of measure convert correctly, variance finally becomes a spotlight instead of noise. The report doesn't just say food cost is high. It points to where profit leaks, portion drift, waste, unrecorded comps, receiving mistakes, even theft. The automated POS mapping alone eliminated 30 hours of manual accounting work every month, an entire FTE's worth of time redirected to strategic analysis instead of data janitorial work. Operationally, the close accelerates because accountants aren't spending nights investigating mystery totals. Leaders get reliable consolidation across locations, and managers can drill down without exporting 10 spreadsheets. By fixing the units of measure framework, we stopped creating duplicate entries. The system went from retrospective scorekeeping to real-time operational intelligence, and for the first time, our historical data was clean enough that AI forecasting tools started giving us predictions we could actually trust. And that brings us to the real payoff. What you can do in the real world when the numbers are trustworthy every day, not just at month end. Trustworthy data turns into practical leverage fast. Now here's where it gets exciting. These aren't theoretical concepts, they're live profit drivers. Picture this. You're managing 15 locations across 3 states. On prime cost, you stop debating whose spreadsheet is right and start managing the actual drivers. With your hierarchical chart of accounts, you can drill from enterprise-level prime cost down to a single store's wine category margin in 3 clicks. Which category is drifting, which role is over hours, which store is an outlier. On purchasing, recipe-linked inventory gives you smarter ordering. Your menu engineering isn't guesswork anymore. It's a live dashboard showing which items are stars and which are profit killers based on real-time COGS. Less overbuying, fewer stockouts, and cleaner vendor conversations because spend is consolidated under one true vendor record. not 3 duplicates. Your AI scheduling system looks at next Tuesday's weather forecast, cross-references it with local convention schedules, and tells you exactly how many servers you need. On labor, consistent sales history and disciplined period closes create scheduling clarity. Instead of reacting after payroll hits, managers can plan proactively, aligning staffing to expected demand, not to gut feel. No more overstaffing on a dead lunch. Your inventory system sees you're at 85% par on short ribs, knows there's a big game Saturday, and auto-generates a purchase order. Third-party delivery fees? Automatically mapped and broken out so you finally see the true cost. And for scale, the impact compounds. When the chart of accounts, POS mappings, units of measure, and SOPs are standardized, opening the next location becomes templated instead of reinvented. The system becomes your competitive weapon. Dynamic pricing during peak hours, personalized marketing based on customer purchase patterns, and supply chain ordering that minimizes waste while preventing emergency runs. This is what happens when clean data meets operational execution. But the biggest implication shows up when you look beyond reporting, because the same clean system that helps you control today is what enables automation and prediction tomorrow. Here's the shift that matters most going into 2026. This changes everything because we've fundamentally redefined what an ERP system is. For decades, restaurant software was a retrospective ledger, a digital filing cabinet that told you what happened last month when it was too late to fix. The ERP can't be treated as a retrospective accounting box anymore. But today, with clean data as your foundation, the platform transforms into a predictive crystal ball. If your goal is AI-driven scheduling, automated purchasing, and better forecasting, your ERP becomes the data spine. And AI becomes a demanding customer of that data because it won't politely ignore messy categories, duplicate vendors, or retroactive edits. It will amplify them. It's no longer about recording history, it's about shaping the future. Your platform becomes the central nervous system that feeds AI and machine learning tools. Demand forecasting isn't a guess, it's a statistical model accurate within 3%. Labor optimization isn't reactive, it's proactive, saving you $1,200 a week. Inventory management isn't a fire drill, it's a precision operation. That's why data governance is not corporate jargon in this context. It's the bridge from we close the books to we can predict next week. Governance means clear ownership of master data, consistent definitions for items and accounts, controlled changes to mappings, audit trails, and a hard close that protects history. And it's also why phased rollouts win. You cleanse, pilot in one location, validate AVT and reconciliations, train the team, then scale with confidence. The paradigm shift is this: you stop being a historian and become a strategist. Your ERP transitions from cost center to profit engine. So the resolution is simple but powerful. Clean data and correct configuration don't just fix reporting, they unlock a new operating model where decisions are guided by reliable signals. And here's the critical part. This isn't a nice-to-have anymore. In 2026, this is the competitive moat that separates thriving restaurant groups from the ones that get eaten alive by market volatility, rising labor costs, and tech-savvy competition. The future belongs to operators who treat data as their most valuable asset, not an afterthought. So if you remember only one thing, let it be this: profitability and AI readiness don't start with dashboards. They start with disciplined foundations. So what does this mean for you? The difference between a system that illuminates profitability and one that obscures it lies almost entirely in the implementation phase. Those 7 critical mistakes we identified, dirty charts of accounts, unmapped POS categories, neglected recipe setups, they're not technical oversights. They're governance failures that cost operators millions in unrecognized waste, labor overages, and administrative inefficiency. Here's your strategic imperative. Treat your setup as a capital investment, not a checklist. Clean and redesign the chart of accounts so reporting reflects how restaurants actually operate: hierarchy, standard naming, granular COGS, and labor. Map POS revenue and tenders with rules so the menu can evolve without creating accounting chaos. Items, tenders, discounts, taxes, new delivery channels. Align the fiscal calendar and enforce a hard close so history stays stable. 13-period 445 cycle, locked periods. Standardize recipes, connect them to inventory, and fix units of measure so AT variance becomes actionable. Case to pound to ounce conversions without duplicates. Merge and govern vendors so AP is accurate and scalable. Duplicate detection, W-9 requirements, approval workflows. And then protect everything with the people system. Training that repeats, SOPs that survive turnover, and reconciliations that happen daily and weekly, not just when the month is already lost. The rigorous work of defining units of measure, merging duplicate vendors, and enforcing 13-period calendars creates a single source of truth that your entire operation relies on. If you're planning a new rollout or trying to rescue one, treat implementation like building a data spine, not installing an app. And looking toward 2026 and beyond, the stakes are existential. The industry is adopting AI to automate complex decisions, but these tools are only as good as the data you feed them. A flawed implementation doesn't just hamper today's reporting, it limits tomorrow's innovation. Because once the foundation is clean, the story changes. The books close faster, prime costs become controllable, and the path to predictive operations finally becomes real. Your data is your destiny. Build it right, protect it ferociously, and it becomes the infrastructure that secures your long-term profitability and competitive position. The restaurants that thrive in the AI era won't be the ones with the most locations or the flashiest menus. They'll be the ones with the cleanest data. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details and description below.